up, everybody? All anyone's talking about today in regard to the housing market is when is it going to crash? How high are prices going to go? And how high are interest rates going to go? I recently did a video on Zillow and Redfin, and I told their predictions for 2022. Although Zillow is much more aggressive, neither one of them are predicting a market crash, and honestly, either am I. But I do think there's going to be a correction in the market if interest rates continue to rise, because as they get higher, housing is simply going to become unaffordable for some buyers, which will cause a correction in the housing market. So today I'm going to bring on one of my favorite mortgage lenders, Michelle.davis. She's amazing. And we're going to talk about everything interest rates, how high she thinks they're going to go, and how it affects the housing market. We're also going to give you some great tips that everybody should know once you're under contract. So before I bring her on, I want to tell you a little bit about her. Michelle.davis has been in the mortgage industry for over 20 years and consistently ranks in the top 1% of mortgage originators in America as ranked by the Scotsman Guide. This past year, she qualified for her company's Chairman Club Award, which puts her in the top 5 volume originators for Prosperity Home Mortgage. She is most proud of her 4.94 customer service rating out of 5 with more than 460 verified surveys. I've got to tell you, any one of my clients that uses her, I'm sure they gave her a 5. If they could give her higher, they would. She is amazing. So let me bring her on. Hi, Michelle.
Hi, Karen. How are you tonight?
Thank you for coming on. I know neither one of us really like to do live videos. We're both a little nervous, but it'll be fine. We will get through this together.
Well, thank you for having me.
I'm really happy. I've been wanting you to do this for a long time, as you know. But yeah. I think right now it's more timely than ever because interest rates, they just keep going up. And we all get a little confused because one day they're one thing, the next day they're another. And I don't honestly really understand who decides what the rates are. So today I want to go over a couple things. I want to first talk about, how do interest rates get, like who decides what they are? Mm-hmm. And then we're going to go over where we think they're going to go in 2022. How high do you think they're going to go and how it affects the housing market? And then we're going to give some tips on like what buyers need to know once they're under contract. Because you and I have had a couple of really interesting deals where things could have gone very badly if you didn't come in and save the day. So first, yeah, well, it's true. And you know what I'm talking about. We won't mention any names today, though.
No names.
So first, let's just talk a little bit about how are mortgage rates determined. Just give us a little demographic for us and tell us how that happens.
Okay, so generally speaking, the mortgage rates follow the general economy, and the Federal Reserve sets the overnight lending rates between big banks. So that's known commonly as the prime rate. So as they raise interest rates, the prime rate will rise as well. And they use the ability to raise or lower these rates to help either stimulate the economy or calm the economy down. In the last couple of months, they have decided that they need to calm down. And the reason for that is because inflation is through the roof. So if they raise the rates, it should slow the spending and calm down inflation a little bit. Go back 2 years to the beginning of COVID, everything hit the fan and everything came to a grinding halt. People lost their jobs or they were put on hold. People stopped spending. Everyone was scared. No one went anywhere. And the Federal Reserve, to try to keep the economy alive and to keep the stock market alive, dropped the rates. And we got to this position where we were seeing 2 point something on every 3-year fixed. And in the last year, 6 months to a year, as we've been recovering from COVID and the economy is getting stronger and stronger, we're seeing the rates slowly rise. In the last month, we've seen the rates rise dramatically. And the reason is because the Feds at their last meeting commented that not only were they going to raise rates this year, but they were going to be more aggressive about it and they were going to do it more frequently. So when that happens...
For 1 second, because that's a lot of information.
Yeah, sorry.
No, it's fine. I just want to make sure I get it. So the Federal Reserve, they decide what the banks can lend to people, like what their rate is. And from there, mortgage lenders, decide the rates based on that, or is it an exact like apple to apple?
It's not step for step at all. Mortgage rates, that is the main driver of what rates are doing. Mortgage rates tend to follow the 10-year treasury, and as that will follow what the feds are doing. So it all sort of falls into place, but they definitely don't go step for step. So for example, when this rate hike happens in mid-March, hopefully a lot of it will have already been baked into this recent increase in interest rates, because they know people know it's coming. So if the Fed does what's expected and raise the rates, the market should be even because they're expecting the Feds to do that. So
they already know now, mid-March, there's going to be another rise. What do you call it? Another hike.
They do. The Feds have all but assured that in mid-March, they're going to raise the rate by a quarter or a half a point. And when it was a quarter point, we knew this was going to happen and rates started going up. And then there were some pundits that thought, you know what, the way they're talking, they might raise it a half a point. And that's when we saw this huge jump where people that were pre-approved in January and called me today for an updated quote were like shocked, because it was 3 something in January and now it's very close to 4%. And that's because of this anticipated rate increase.
So why does it change day to day? Like, that's the part that I think confuses people, because they're like, and then I have a follow-up question to that, because I get, some of my clients, and they're like, well, I saw online, the rates, 1.7. I'm like, but that's just not true. So I want to know 2 questions. One, how do they change day to day? Like, why is it a daily, or is it hour to hour? I don't even know. And why do we see online these lenders? And I put them in quotes because I've never heard of the ones that when people tell me that.
Yeah.
That are advertising these rates that are just not true.
Right. Okay. So first, rates can change daily and sometimes do, and they can change during the day and sometimes do. Each lender sets their own rate each day, and they tend to follow the trends. And the trends are again, this 10-year treasury will move depending upon economic data. So when jobs reports come out and they're stronger than expected, you can expect rates to go up. When it's weaker than expected, you can expect rates to go down. When the stock market's doing really well, you can expect interest rates to go up. When the stock market's going down, you can expect interest rates to go down. So
recently the stock market was going down because I think it's what's happening, the possible Russian invasion. But so does it immediately?
You're absolutely right. And that is not typical. Typically, as the market rises in general, interest rates will rise. And one of the reasons for that is to attract buyers from the stock market to interest rates or to bonds, for example. So a higher yield on a bond is more attractive. And so the rates will be risen for that reason. But that's just one reason. What's happening right now is really about what happened to us during COVID and now recovering from that. We're really, if you think about it, just normalizing where we were pre-COVID. So even though rates aren't 2-3%, they're sort of in a normal range at 4%. And we can look at, a chart over the last 20 years and see when it was 16 or 18%. It's really a dramatic thing to see how low we really truly are.
A lot of times people like to look at that 30 years to justify rates are still historically low. Do you happen to know, and I know I'm putting you on the spot, but do you happen to know what the rates were like January 2020, just before the pandemic hit?
Yes, they were in the upper 3s. So we are back there and exceeding it, but we're back to where we were pre-pandemic. Absolutely. And like I said, exceeding it, I think.
So it's not really, it sounds like a lot because we were so low. And I know, me included, everybody, I know we all refinanced because it was like incredible.
Yeah.
Which I think also is affecting the housing market because people that refinance don't want to move anymore because they have such cheap money right now. Do you know what I'm saying? That's another factor that we don't really talk about, but I'm just talking out loud. So now I have another question. Based on this internet lender example I'm giving you.
Yeah.
Is that about fees? Is it about points? Like, how are they advertising these rates where I talk to you every day and I know you're the best of the best. Yeah. And you're not going to give me and my clients a rate that is the best possible rate you can get. So how is it so off? Like, what is that about?
So there's a combination of things, but they're legally, they have to give some fine print, but it is very fine print. Sometimes you really have to dig to see what's going on. But a lot of times if something's super low, it's not a 30-year fixed rate. It might be a 10-year or a 15-year. Almost always will have points associated with it. And a point is simply a fee of 1% of the loan amount that's charged at the time of close, and it lowers the interest rate. But some of these will have 3 points associated with them, which means a lot more cash due at closing. Some of them are assuming a 50% loan to value, meaning if you're buying something for $500,000, you're putting $250,000 down. Some will assume an 800 credit score. So there's all these assumptions in there, and you really have to dig through it to find out what's realistic. And it is also true there are some lenders that are particularly low, and those tend to be the big internet ones that don't have a lot of overhead, because one of the things that gets baked into an interest rate is the yield that a company needs to get from that mortgage to pay underwriters and processors and loan officers and closers. That all gets baked into it. So if you're looking at something like a Rocket, where there's not a lot of customer service and a lot of it is done simply online, it's cheaper for them. And so maybe they can go deeper, or because of their sheer volume, they can go deeper on the interest rate.
Right. But the problem that me and a lot of my colleagues, and I'm going to get to the comment in a second, have run into is they don't understand our contracts, and they don't understand our timing, and they don't get the appraisal done in time. And then the buyers get in trouble, and you have to come in and save the day, which you've had to do for multiple agents that I know many, many times.
Mm-hmm.
And so it's one thing, yes, maybe this company who has 1 million, employees and no overhead and can do all these loans, they may be able to give it a lower rate, but if the buyer can't close and they're in default, ultimately it's going to cost them more. So I really want to just point that out, because it's not always just about that number. It's about making sure that you can adhere to a contract, especially in today's market where every house is in multiple offers, and the sellers are very picky about which buyer they choose and if they know the lender, because they want to make sure it's going to be seamless. They don't want to go back on the market because they know they'll lose money. And it's just a lot to take in.
And as you can imagine, if someone does an online loan application and they just type in whatever they're typing in and they get spit back a pre-approval letter, well, junk in is junk out, right? So if they're talking to a human being that asks questions and says, oh, well, I know you have any payments on your student loan, but what's the outstanding balance? Because ultimately we're going to have to associate some payment with that. Or, oh, do you have any Schedule C income? And is that number you're giving me the top line of your Schedule C or the bottom of your Schedule C? So when you have that sort of internet thing going and they're spitting out pre-approvals, they're really, maybe not worth the paper they're printed on. And sometimes they are. Sometimes someone's very straightforward and it's fine. But there's so many levels and layers, and underwriting is very stiff right now. They're really looking at everything very closely, that it's really helpful to have a human being ask the questions and unearth potential issues.
Right. And when there are potential issues, to have a human being fix them, which a lot of us call Michelle the fixer. So we have a question. I don't know if you can see this or not, but it's from Sobriety Television. It's a fun name. Do you speculate that 2023 will have lower housing prices after the Fed raises rates? So I think it's a question for both of us.
Mm-hmm.
Let's start with, how high do you think the Fed is going to raise rates? Do you know, or do they tell you? I mean, you said they're going to do something in mid-March. Like, do we know the rest of the year already?
So it could be a full point over the coming year. So prime is currently 3.25. So prime could potentially go to 4.25 by the end of the year. So interest rates could go mid fours, I would say. Remember, I said a lot of what we're expecting the Feds to do is baked into the current interest rates already, because we're expecting it. So hopefully we're going to stay in the fours. I mean, last year, people were predicting some the threes, mid threes by the end of the year, and some, by the end of the year at 4. But I think we're going to be in the fours. And to answer the question, and you can answer it on the higher priced things, but I do think the lower priced condos, first time home buyer, it is going to negatively impact the buying ability, and therefore potentially the purchase prices. of those lower priced properties that people are looking to get into, first time home buyers that are now going to be priced out because the interest rate has risen so much they can no longer afford it.
Yeah. And it's, if you bring up what you think, where you already brought up where you think the interest rates are going to go into the year, I'm going to just bring up this article. And this is 2 weeks old. It's not yesterday, but it's not last year either. And this is where they say, heading into this year, Fannie Mae predicted we'd hit a 3.3 mortgage rate by end of 2022. Redfin projected a 3.6 mortgage rate. And the Mortgage Bankers Association predicted a 4% rate by the close of the year. It sounds like we're already past all that.
We're there. We're definitely there. And, predictions are just predictions, unfortunately. And, Karen, honestly, if we had another COVID breakout, if something shut the market down, we could very well drop again. But I think we're on a pretty decent road to recovery. And I think even if there's a COVID variant with this most recent one, we've managed to get past it fairly seamlessly. And I think that we're at a point where rates are we're not gonna see a 2 or a low 3 again for some time.
Really? So that's interesting. I mean, I agree with you. I think that was really special, special circumstances. And unless something like that happens again, 4%, 3.75. I mean, these are great interest rates. These aren't, I don't know if they stay 4 below, I don't know if that's going to have a huge impact on the housing market, to answer the question. I just don't know. I think as interest rates get higher, if interest rates get higher and the prices continue to get higher, it's definitely become unaffordable, especially for the first-time buyers that are trying to get in the market, because they were approved maybe, last week or last month at a certain price point. Well, if interest rates higher and the prices are higher, they're just going to get priced out of the market. So so if more buyers get priced out, it will cause a correction because there's less buyers, and those sellers have to sell to somebody, and it all works together. So it's interesting. I mean, I think that we'll just have to see. So talk to me a little bit about fees and points and basis points, just so people get the whole picture of when they're getting their mortgage rate. What can they expect? What does a point mean? I just, I don't want to take too long on this because I know it's not the most fascinating stuff, but I think it's important for people to understand, like, when you see these lower rates advertised and there's a point or 2 points, involved, like, what does that mean?
Yeah. And just one of my least favorite questions is, what's today's rate? And the reason is because there are so many different things. The interest rate, not just what's happening in the market, which certainly is a big piece, but also the individual, how much money they're putting down, what's the size of their loan, what's their credit score, are they paying any points? And a point specifically is a fee of 1% of the loan amount paid at the time of close that reduces the interest rate. And typically, but not every day, 1 point will buy the interest rate down by about a quarter. So that means if we're at 4% with no point, and you're paying 1% point of the loan amount. So if it's a $400,000 loan, that's a $4,000 fee. It'll reduce the interest rate to 3.75. So you're getting a 0.25% drop on the rate for that 1% of the loan amount cost. And that's paid one time at close, and you get that rate for the life of the loan. So when you compare the cost to the monthly savings that you're getting, it typically takes 5 to 6 years to recoup that upfront point that you're paying. So if you're a first-time home buyer and you're in a condo that you're going to be in for 3 to 5 years, it doesn't make sense to pay the point. You're not going to recoup it.
I was going to ask you that question. How long would it take to recoup that money? So it's traditionally about 5 to 7 years, you're saying? Yeah,
5 to 6 years. And there are times when a point will buy the interest rate down more, and then it gets more interesting. And people want to pay it because it's buying more than just that quarter of a point. It might be getting them to 3.625. And so that's a shorter time frame to recoup it, and it makes more sense.
Mm-hmm. Yeah. I guess it just depends on the whole picture. And I know that you're really good about talking to buyers, when they are talking to you about what their expectation is, how long do they think they're going to live in the house, all that good stuff. It's another reason why you need a real person, because they can help you decide the big picture, what's best for the buyer. If they're saying they're only going to be there for 3 to 5 years, they're like, this is my forever home. and might make a big difference, for the 25 of the 30 years of the loan,
You're
So I think,
absolutely right. Yeah.
yeah,
Yeah.
another thing to find out. Okay, so we already talked about this a little bit, but I want to go back to where are rates headed in 2022. I know you said that you think they're going to go a little bit over 4. Do you think that there's a chance that we'll go over 5? I mean, is that even in the periphery? Is that even a possibility? Or are we pretty comfortable? Like, do buyers need to buy right now when they're at 4 or hovering right below, or in 3, 4, 5 months, or will it still be not that different?
Yeah, it's a really good question.
I know, your magic ball, get it out.
And I know, and I wish I had one. People ask me all the time, well, should I lock? And that's actually another good point to make, is when can I actually lock an interest rate? And you can't lock an interest rate until you've got a ratified contract. So you've made an offer on something, it's been accepted, you've got a close date. And on that day, you can choose whether or not to lock the interest rate. And people say, should I lock it? Should I float? Meaning don't lock it yet. And I just say, you know what? 3 things can happen. Rates can stay the same, so lock. Rates can go up, should have locked, or rates can go down. 2 out of the 3 say, just go ahead and lock it. And when they're as volatile as they are today, and you're comfortable with the payment, I think you should just lock it in. As far as, if we'll go over 5% for the year, gosh, I really hope not. I don't think so, but the last few weeks have definitely scared me, how dramatically rates have risen and what's potential. But I do think we'll stay under 5. Is my opinion.
The whole reason I even bring that up is because I just read those predictions from Fannie Mae, and that was 2 weeks ago, and like they were 2 of the 3 of them are already wrong. So I'm just wondering, like, what could possibly happen that would make it even more different. Going up as high as 4.5 to 5%. And I know you don't have a crystal ball. We don't know what's going to happen. If something happens in the world, it affects everything, especially our housing market. So I get that you don't know, but it's a question I have to ask, because when I have my clients and they're like, I need to buy right now before they go up. And I'm like, you need to buy when you find the house you want to live in. You know what I'm saying? I don't think it's going to be that drastic change, but I'm not a lender, I'm a realtor. So I wanted definitely to get your opinion. If you think there's a real sense of urgency now compared to in the next 3 or 4 months, not the next 3 or 4 years, next 3 or 4 months.
Yeah. I mean, I go back to saying that I think the younger first-time home buyers at the lower price points, they're feeling that urgency, because what tends to happen is those buyers are sort of maxing out what they can buy, right? Because they're just getting into the market, as opposed to someone who's buying in, the $800 million, $2 million range. They're typically not maxing out their debt to income ratio. They can afford an interest rate increase, right? They're still going to buy the house that they want to buy. Whereas these younger buyers, like, for example, on a $250,000 loan at 3%, the principal and interest on the loan, so not the taxes and insurance, just the basis of the loan, is $843. And at 4%, it's $955 a month. So that's 1% point jump, which is what happened in the last 2 months. And it is a big difference. And so it's hard to say to them, hey, look at this interest rate chart, how high rates have been historically. They still can't get past the fact that it starts with a 4 or even a 3 sometimes. And that's a higher payment. And so they may back out, waiting to see. And sometimes waiting to see just makes things worse because values continue to rise and rates can go up.
Yeah. And like you said previously, it's not just about that interest rate. It has to do with the client's credit score and, how much money they have reserves and, all that other stuff that goes into creating the best interest rate for them. What these days is the cutoff? I know it used to be 720, and then I think it was 760 as far as credit scores to get that best rate. Like, what is that cutoff today?
So there's 2 conforming loan limits. One is a low balance, which is a lot of states in the country. We happen to be in a state that has a higher median income level. So we have 2 levels. So the conforming loan limit sort of everywhere is up to $647,200. So $647,200. The high balance loan limit for the higher income states like DC, Virginia, a lot of the counties, Maryland, a lot of the counties, is actually $970,800 now. So, and what that means is you could for $950,000, $980,000 with only 5% down, which
That's
is,
amazing. But actually what I was asking was credit scores. That's what I meant. Like what credit score do you have to get the best interest rate? It used to be 720 and then I think 60.
So 740 is typically the number you're looking for to get the best interest rate available. If it's a jumbo loan, which is a loan that's over that 970 figure I just mentioned, the higher the score, the better. If you're at 800, you're going to get a better interest rate than someone who's just at 740. But at that 970 and below, the target number that you're looking for is 740. And every 20 points can affect the interest rate. So if you're at a 720, you could be, rather than be at 3.75 with no points, you might be at 3.75 with a quarter point. At 700, same thing. So as you go down, it definitely impacts your interest rate, and it makes a big difference sometimes for people that, that are on the verge of qualifying.
Yeah. And I know there are certain companies, I think Credit Karma is one, where you can pull your own credit and just to see where you're at. Mm-hmm. And if you're on the cusp, it might be a good idea to, when they call you and talk to you, to say, I did this myself. I know it's not completely accurate because you guys pull from 3 different, I think, credit bureaus or whatever it's called. But if it's on the cusp, it may behoove them to, if they can, pay some debt down, do something creative to get it up, to get the better rate, which is also a reason why you need to talk to a person. Because the internet's not going to help you out that way. I've seen that in the past.
You're absolutely right. And you bring up a good point too. People that look at their credit scores online or on their bank account spits out a credit score, or Credit Karma does, it's going to be different than what a lender pulls. And the reason is there's a different calculation used when interest rate or credit reports are pulled in conjunction for a mortgage than we see on the screen. And most frequently, the score is going to be a little bit lower than what you see. And as you mentioned, we're going to pull from all 3 credit bureaus, so TransUnion, Equifax, and Experian, and we're going to use the score that numerically falls in the middle. So if they're looking at a TransUnion score at 740, but then they've got one at 700 and 680, the score that's going to be used is 700, and they've only seen one piece of that. And the biggest, quickest thing you can do to improve your credit score is to pay down credit card debt, to pay down revolving debt.
Right. And how long, I don't know if you know the answer to this, but how long would it take? Like if I did pay down my credit card debt today, how long will it reflect my credit score?
As little as 30 days. It just depends on when that creditor reports into the bureaus. And unfortunately, there's not a specific date. I wish there was. Like everyone reports in on the 15th. So, if you paid it down before the 15th, you were good to go. But that's not the case. So if you need to wait, I would wait 30 days and then look at it again. But actually having Credit Karma is really good for this, because you can see when the Credit Karma score jumps, it's been impacted. So then you can have the lender pull it. And even though it might not be the same score, it will have gone higher.
Yeah. And that's actually 30 days is in this crazy market, is a long time. So I think if, we're just entering the spring market now here in DC and Montgomery County and where I work. And it's really, I see a lot of listings coming on now, and they're going really quick and multiple offers. So 30 days is significant, so I do think that if you think that you might be on the edge and you really want the best rate, you may want to start looking into it now, even if you're not going to buy, for a couple months, because there may be things you can do to get your credit score up, and then you get your interest rate down, and just listening to you give the different scenarios, it could be a big difference in the monthly payment. At the end of the day, it's all about the monthly payment.
Absolutely. And Karen, we looked at a $250 loan on $800,000 loan. Between a point is $500 a month. So you're going from, on an $800,000 loan, $3,300 a month to $3,800 a month. So it's, it really makes a difference. And it behooves you to keep an eye on your credit and make sure things aren't popping up that you're unaware of, or that you need to get fixed before you step into purchasing a property. Yeah,
that's good stuff. And as far as locking your interest rate, you can't do that through a ratified contract. You can't just lock it in today.
There are programs. There are some programs where you can lock a rate for a specific period of time prior to identifying a home, but you pay a premium for it. And then if you don't purchase within that time frame, you pay a premium again. So it almost doesn't make sense if you're paying, let's say you're paying 1.5 points in premiums. You might as well just sort of wait it out until you find a property. And then if you didn't pay that 1.5 and rates stayed the same, you're good. Or if they went down a little, you could then use the money to buy down, or go up a little, you could then use that money to buy down the interest rate. So those tend to be a little bit more costly than worthwhile. So when you've got that ratified contract and a close date, I think you asked me once earlier about a 30-day lock versus a 45-day lock versus a 60-day lock. Mm-hmm. So the longer lock you need, the more expensive it can be. And that's because the lender is holding this money for you for a certain period of time. And if you need it for a longer period of time, and then you ultimately don't buy, they have lost money on holding it, waiting for you to go to close. So that's what it impacts. It doesn't typically affect the interest rate as much as it would a fee that goes along with the interest rate that you're getting.
Yeah, that's good to know. Most contracts are 30 or 45 days. I haven't seen a lot that go to 60 days, especially in this market. But sometimes that's what the seller wants. They want to be in the house as long as possible.
Yeah.
That happened to me last year with one of my sellers that I want to be here 4 months. So give me a 60-day, contract to close, and then a 2-month rent back. And it was such a seller's market. I got him what he wanted, but that buyer had to have a 60-day, contract to close. Yeah, that does happen. It's just right now we're pretty much at the mercy of what the seller wants if you want to get the house.
Yeah. And you mentioned a 60-day rent back. And the reason for that, if people don't know, is because when you purchase something as a primary residence, you have to move into it within 60 days of closing for it to be considered your primary residence. And there's even a legal rider that you sign at close that says, I intend to take occupancy within 60 days. So if you've got a 4-month time period in which the seller doesn't want to get out, you have to push back that closing until you're within 60 days of them getting out, so you can get in and get that primary interest rate, because there's a big difference between a primary mortgage interest rate and an investment property interest rate.
Yes, that I know. I know. And also we always, as realtors, we always know that you can only rent back, for 60 days because of the loan, but you can do for less. It's just 60 days is the most you can, the seller can for a week, right? It just, they can't get longer than 60 days because then it impacts the buyer. And
exactly.
They're not moving in.
Exactly. Yep.
All right. Well, there's a lot of information. It is, but it's important, because I think that when we're talking about the housing market these days, and everyone keeps saying, "Is it going to crash? It's going to crash." For me, it's pretty simple. As long as the supply is less than the demand, it's not going to crash. But will it correct itself? If housing becomes unaffordable for certain buyers, and then those sellers can't sell to them, then they can't buy. I mean, it trickles up. So I do think it's really important to know what interest rates mean, know how you get them, know how you can get the best interest rate to get the lowest monthly payment, and how that could affect the housing market. I think that even though 4% is still really low, it is higher than it was 6 months ago, even a month ago.
It is.
And it definitely creates, in my world, tension. And anytime there's tension in my world, in the real estate world, people either freeze. It's like that fight or flight.
Yep.
They're either like freeze, or they don't, or they want to move fast, or they don't. And anytime it gets really hectic like that, I don't think it's good for the housing market. It makes it very less stable. And all that frenetic energy is just not good for anyone.
I agree. The volatility is awful. The lenders hate it as well, as you can imagine. It's not easy, talking to someone and telling them the difference, between 2 weeks ago and today. It's hard to
That's got to be swallowed.
Yeah.
All right, I'm going to pivot a little bit, because that was a lot of information, a lot of serious stuff. And if anybody has any questions for Michelle and you're not live, you can always put it in the comments. I see her every day, so I'll make sure they get answered. If it's something I can't answer, then I'll make sure it gets answered by her. So I want to talk about, and I've mentioned this in some of my videos because it happened to us. We're not going to mention any names because I don't want to embarrass anyone. But besides what happened to me, I'm sure it's happened with other situations and other buyers. What should you not do once you're under contract?
All right. So once you're under contract, you should not change jobs or quit your job. I actually had someone quit their job once because within a week of closing, we're going to contact your employer and we're going to say, hey, are they still gainfully employed? And one time I heard, no, they are not. They quit last week. And the buyer thought, oh, well, I thought I was done. My loan was approved. And I said, well, no, we verify that you're still employed just prior to close. So don't quit your job. Or if you're going to get a new one, make sure it's a salaried position. Don't immediately decide you want to go into your own business because that will also ruin your loan. And a biggie for younger buyers or people who are sort of maxing out what they can buy is don't open any new lines of credit. So don't take out any new loans. Don't buy an engagement ring for your future girlfriend or fiance. Don't buy a car. The old adage is if you buy a car, you may find yourself living in it. And the reason for this is because we're not going to repull your credit, but we are going to monitor for inquiries. So if you inquire about a car loan between the time you go under contract and the time you close, the lender's notified and they say, oh, there's a car loan inquiry here. So we're going to call you and we're going to say, hey, there's a car loan inquiry. What's up with that? And if the person says, well, I bought a car, then we're going to say, okay, we need all the documentation and we need to add it to your liabilities and hopefully you still qualify. So it's, a lot of times people will call me before they do something and they're fine, right? I can say, oh, no problem. You can take a $600 payment. No problem. We're just going to have to document it. But then sometimes people will do things without mentioning it or checking in, and it does negatively impact them. And then there's a lot of cleanup work to do.
I'm surprised people call you, to be honest. I'm surprised they even think that way because what happened with two of my clients with you is they needed a stopgap money to pay the EMD, the earnest money deposit, and the closing costs. They didn't think anything of it. They were like, they went and got a quick loan that was advertised. They knew what they were going to pay it back. So they were getting money from their parents. And little did they know how badly it impacted the day before closing. For the first example, the second example actually didn't impact them.
No, it didn't.
It's all about the debt to income ratio. But the first example, the day before we were clear to close, which means we're done. We're just showing up and signing papers. And I get a call from Michelle, which I never want to get the day before closing. No offense. I hear from her the day before. I'm like, what's wrong? And do we have a problem? And she's like, yeah, we do. And our buyer took out some stopgap loans, just knowing he was going to get the money from his mom a couple weeks later when she sold her house and not thinking anything of it. They got approved. Everything was fine. Nobody said anything, but they got flagged. How did you know? How does that happen? Because
when they got the loan, their credit was pulled to get the loan. And when credit is pulled, we're notified of the inquiry. So the inquiries are monitored. So that's when I called him and I said, hey, what is this? And he said, oh, well, it's a loan for the down payment and closing costs. And not only does that negatively impact your debt to income ratio, but you can't use borrowed funds for down payment and closing costs. It either has to be a gift from a family member or it has to be your savings, or you can borrow against your own retirement account, but that's the only time you can use a loan for down payment and closing costs. So even if he could take it in his debt to income ratio, you can't use that money. And Karen, the reason that people tell me is because when someone ratifies a contract and I send them an email about next steps and moving forward, I say, before you do anything, give me a call. And somehow these two buyers either didn't read it or didn't think that it would impact them.
Right. Yeah, that's interesting. Fortunately, they did get the gift from the mom in time and paid off that loan, and it all worked out. But boy, that was no fun.
It was not fun. It was not fun. And you feel terrible because I'm not scolding him. I'm just basically saying, we got to fix this. But he was great, this particular buyer, and he was all about doing whatever he needed to do to fix it. And that always helps get to the end game.
Is there any other things that have happened with hopefully I'm not the only one, with other agents that, you said somebody quit their job. Is there any other examples you can think of, like what not to do once you're under contract? Don't buy a house, don't buy a car, don't buy anything, don't do anything that creates a loan. Is there anything else that could possibly impact?
Don't keep anything from your loan officer. Really tell them everything. Like if you pay alimony, tell them. If you have an IRS obligation, tell them, because at some point during the loan process, if I don't notice it on a pay stub, maybe an underwriter sees, hey, what's this payment to something, and go back and you say, well, what is that? And they go, oh, well, that's alimony that I didn't tell you about, or, child support or something. So it's so much better to just be fully upfront at the beginning and let them know everything that is going on. And they can help you either work around it if that's possible, or what you need to do to get yourself into a place where you can buy what you want to buy. So that's my number one, really, is just to be forthright and get all that information out there. And when you do the loan application, answer it as honestly as possible.
Yeah. Let me ask you a question. Have you recently had anybody try to pay either the down payment or closing costs with Bitcoin?
Yes. Not myself, but a colleague of mine. And so we got into a big discussion about it with my colleagues, and you can use Bitcoin. However, you need to show a 60-day history of your purchasing of the Bitcoin. Or if you've had it and, for 60 days, you just need to show something that gives us a beginning balance, let's say on January 1, and then an ending balance on February 28th, and any activity between. And then you have to move it from there to a regular checking or savings account in order to be able to use it. But you can use it. You need to be able to show a history. And the history can bring up some questions, because if we see, on January 15th, you bought $100,000 worth of Bitcoin, we're going to need to know where that 100,000 came from. Yeah. So you can sort of go down a rabbit hole when you get into bank history, but you can do it. It's a lot of documentation, and you have to move the money before you could use it, but you can.
Yeah. I mean, people ask me about that when they want to pay cash. I'm like, you have to transfer into dollars first. It's just a simple answer. No seller is going to accept Bitcoin as payment today.
Right.
February 2022, maybe one day, but not today. Today, you have to just transfer that into a bank account and into cash, and then
Yeah, certainly if you're getting a loan. I mean, you may have a seller out there who'll say, I'll take your Bitcoin, but if there's a loan associated with it, it's got to get into dollars.
Yeah. All right, Michelle, well, there's a lot of information. I really appreciate your time. I really appreciate your expertise, and I really, really appreciate you. We've worked together a very long time, and you have done always an incredible job for all of my buyers, whether it's an easy one or a very difficult one. You and I have talked, at 11 o'clock at night to 5 in the morning, solving problems that we had to. And that, to me, is priceless.
Well, I want to pay it back to you, because there's a lot of times when there's a problem on a loan and I'll talk to a realtor about it, and it's like, the world has ended, and, head in the sand, or they're very angry. And Karen, you were like, all right, let's figure out, what do we need to do? Literally roll up my sleeves. Let's figure it out. And that makes life so much better. And for that reason, you're such a pleasure to work with. I know that if anything comes up, you'll just figure it out.
We figure it out. We do. May have a couple of drinks while we figure it out. Maybe share the beers, but we figure it out.
We do.
All right. Thank you so much. If you all are watching this on replay and you have any questions for Michelle or me about interest rates, how high they're going to go, how it's going to affect the housing market, if we can answer them, of course we will. I'm going to put all of Michelle's information in the comments below, so you can contact her directly if you're thinking about buying. Hopefully you're contacting me as well, because we love to work together. And I just, once again, I thank you. Thank you for coming on. I might ask you to do it again one day, but for today, that's all. And I will see you in the office.
Thanks, Karen. Have a nice night.
Bye.
Bye.